Okay, once again, this question, September 18, another practice question, and that's was, as I told you earlier, that was the first exam session conducted by the examiner. So let's start the game here. Okay, what's the question? The question is about draft and explanatory note to the directors of Banana discussing the following. How goodwill should have been calculated on the acquisition of grape. Goodwill calculated. And show the accounting entry which is required to amend the finance director error. Candidates, examiner first already mentioned draft and explanatory note. Means if sub requirement means A1, A is headed by explanatory note. In A1 mentioned that calculate the goodwill. It means by default we have to write the all working. Okay, so there are two things, goodwill and some accounting entry aspects. Why equity accounting was appropriate treatment for strawberry in the consolidated financial statement up to the date of disposal, showing the carrying amount of investment in strawberry just prior to disposal. Another point is equity accounting was appropriate treatment strawberry consolidated financial statement up to the date of disposal, showing the carrying amount of investments strawberry just prior to disposal. How the gain or loss on disposal strawberry should have been recorded in consolidated statement of financial position, and how investment in strawberry should be accounted for after the part disposal. Okay, so a question is more resemble with the previous question, but it doesn't mean that same question will happen in the exam. The situation will be different. Okay, so information: Banana is a parent, a listed group of company which have an year end 30th June X7. Banana has made a number of acquisition disposal of investment during the current financial year. Director required advice as to correct accounting treatment of these acquisition and disposals. The acquisition of grape. The acquisition of grape, 1st January X7. Banana acquired 80% equity interest in grape. Following the summary of grape equity at acquisition. Equity share capital $1 each. Retained earnings, other component equity 8. Purchase consideration comprised. Do remember 1st January X7 is the mid of the era. The net asset of subsidiary at acquisition date. Equity share capital, retained earning, OCE. Purchase consideration comprised 10 million. Comprised 10 million of banana shares which had a nominal value of $1 each and a market price of 6.8 each. So purchase consideration 10 million of banana shares, means parent shares, which had a nominal value of $1 and a market price 6.8. Additionally, cash 18 million was due to be paid 1st January X9 if the net profit after tax of grape grew up 5% in each of the following 2 years following acquisition. Okay, cash of 18 million due to be paid 1st January X9 if the net profit after tax of grape grew by 5% next 2 years following acquisition. Candidate, this is what the contingent consideration. And this is based on cash, that means it's a liability. And contingent consideration should be valued at fair value. $18 million cash due to paid first January X9 net profit after Grape grew by 5% 2 years following the acquisition. The present value of the total contingent consideration first January X7 16 million, and it was felt that there were 25% chances of the profit target being met. 25. Another important point. Accounting standard mentioned that if the probability adjustment um, evaluated, then it should be the part of the present value. So what I suggest here, the contingent consideration should be 16 million into 0.25, not the 16 million. That's a 4 million. That's important. Another point, at acquisition, the only adjustment required to the identifiable net asset of Grape was for land, which had a fair value of 5 million, higher than its carrying amount. This is not included in the 70 million equity of the Grape first January X7. Okay, that's another point. Fair value adjustment, and that's need to be incorporated. Goodwill on consolidated financial statement has been incorrectly calculated. That is correction of error. Error. Share consideration 68 million. NCI acquisition 20% of the 70 million. That means no fair value adjustment. Less net asset at acquisition 70. That means goodwill at acquisition. Financial director did not take into account the contingent consideration, contingent cash. It was not probable that it would be paid. That is wrong. Additionally, he measured the NCI using the proportional method, despite the group have published the policy of NCI at fair value. Another important point, NCI using proportion, published policy, NCI. So, how much aspects? Number 1, number 2, number 3, number 4, NCI. These are the aspects: contingent liability, NCI, fair value adjustment, goodwill, and correction of errors. In fact, this one, fair value adjustment. So another one, that's acquisition and subsequent disposal of subsidiary. Banana had purchased 40% equity interest in Strawberry, 18 million, a number of years ago, when the fair value of the identifiable net asset 44 million. Since acquisition, Banana had the right to appoint one of the 5 directors on the board of Strawberry. The investment has always been equity accounted for in the consolidation financial statement of Banana. Banana disposed 75% of investment. 1st October X6 for 19 million. When the fair value of the identifiable net asset of Strawberry were 50 million. At that date, Banana lost its right to appoint one as director to the board. Hence, the fair value of the remaining 10% equity interest 4.5 million at disposal, but only 4 million 30th June X7. Banana has recorded a loss in reserves 14 million calculated. A difference between the price paid 18 million fair value 4 million at the reporting date. Banana has stated that they have no intention to sell their remaining shares in Strawberry and wishes to classify the remaining 10% interest fair value through OCI in accordance with IFRS financial statement. Candidate, I want to discuss a very important point with you. Very important. And that is about the case of associate. Associate means investor has significant influence over investee. And this means rights to participate only, but not control. Most of the time, it happens 20% plus, but agreement also need to consider if less than 20% sharing. This is the point. And you know very well about this. The accounting treatment the accounting treatment cost of investment plus share and post acquisition reserve, retained earning plus OCE plus or minus if any adjustment. Total comprehensive income, income statement, share and profit of associate. A stand for associate. Share in OCI gain or loss of associate. Maybe the foreign exchange matter or the revaluation aspect like this. That is what the simple aspect. But candidates, some more complications here. That is about change in structure of associate. Number one, disposal of associate. 100% disposal or become simple investment. There are two particular cases. Disposal of associate, 100% disposal or become simple investment. And number two, we will discuss with the next session on tomorrow for number two matter. Simple investment become associate. Candidates, we have done or we are working most of the matter related to the disposal. That's why I'm working for this. I'm working for this with the case of disposal of associate. It is just like the sale of subsidy and control lost. But here the case, significant influence become lost. Significant influence become lost. How to work out on this? It's very simple. What is our position? Fair value of consideration received, fair value of remaining investment if become SI simple investment. And carrying amount of investment in associate at disposal. The notes I have already given with you, that's mentioned, already mentioned this one. So the point is either the gain or loss. This is what the matters. We'll discuss later about the simple investment become associate. So candidates, actually the case here the same. Banana had purchased, once again I'm going to repeat it. Banana had purchased a 40% equity interest in Strawberry 18 million a number of years ago when the fair value identified net asset 44 million. Since acquisition, Banana had the right to appoint one of the 5 directors of the board of Strawberry. Investment has always been equity accounted for in the consolidated financial statement of Banana. Banana disposed of 75% of its 40% investment 1st October X6 for 19 million when the fair value identified and net asset of Strawberry were 50 million. At that date, Banana lost its right to appoint to director to the board. The fair value remaining 10%. That means associate to simple investment. Banana has recorded a loss in reserve 14 million calculated at a difference between the price paid 18 million and the fair value of 4 million at the reporting date. Banana has stated that they have no intention to sell their remaining shares in Strawberry and wishes to classify the remaining 10% investment at the fair value through OCI in accordance with the IFRS 9 financial instrument. This is the point. That is the game. Requirement draft explanatory note about the grape. That is 1. Goodwill and accounting entry. Equity accounting and the why equity accounting was appropriate treatment Strawberry in consolidated financial statement up to the, try to understand the question, up to the date of disposal. So Strawberry, two requirements related to Strawberry. Number 1, why equity accounting was appropriate? Strawberry in consolidated financial statement up to the date of disposal, showing the carrying amount of investment Strawberry just prior to disposal. How the gain or loss in disposal of Strawberry should have been recorded in consolidated financial statement, and how investment in Strawberry should be accounted for after the part of disposal. There are 2 requirements. If disposed after disposal, that is fair value through OCI. Now one by one. First point is about grape. And grape about, just recall quickly, issue related to fair value of contingent consideration. Yes, that's related to cash. Fair value adjustment of the land, that's error, not fair value adjustment incorporated. NCI, full goodwill to proportionate. Now start. Here is the suggested answer. Yes, number 1, the important point. You have to write these two terms, explanatory note, and you have to explain the answer accordingly. First one is about, you should have to have, I recommend that your solution is not headed but exam solution, but you can head it, huh? That is fair value of consideration received, contingent consideration. Number one, case reference, knowledge, application of knowledge. Once again, that is goodwill should be, here the case, goodwill, it's a description of goodwill. Goodwill should be calculated by comparing the fair value of consideration with the fair value identified asset at acquisition. And now, case. Case. The shares have been correctly valued using the market value of banana at acquisition. Okay. Shares. Two things. Shares, huh? There are two consideration here, candidates. That is number one, the shares, and number two, contingent consideration. Contingent consideration should be included at its fair value, should be assessed taken into the probability of the target being achieved as well accounted, discounted to the present value. Yes, absolutely right. Once again, and this is the matter. It would appear reasonable to measure the consideration 16 million into 25%. That's a matter. Fair value of consideration, contingent consideration. You refer the shares, it's good, it's correct. Goodwill, what is the meaning of goodwill? Then cost of investment, case, this one. A corresponding liability should be included. Why liability? Why liability? Why liability? Because of cash contingent consideration based on cash should be included within the consolidated financial statement with subsequent remeasurement. Because it's cash, that means subsequent remeasurement. This would be adjusted prospectively to P&L rather than adjusting the consideration and the goodwill. Yes, that is important. If fair value, if the contingent consideration fair value aspects will be remeasured in the future, it's not about the goodwill adjustment. But yes, anything is probationary, or probationary means the value is not reliably measured at the acquisition date. Either NCI, either cost of investment, or either net asset of subsidiary fair value at fair value. That should be and within 1 year, then goodwill should be readjusted. But the question is that this is the contingent consideration based on cash, and liability by IFRS 9, if it's based on fair value, then need to remeasure subsequently. And that point, subsequent remeasurement, no adjustment with the goodwill, but yes, profit and loss account. That's done. First one, fair value consideration. Now, second one, they discuss the point, the NCI. They have wrongly entered the NCI at fair value and they're putting the adjustment accordingly. Finance director has erroneously measured NCI using the proportionate method rather than at fair value. Yes, because they have published the policy to measure NCI at fair value. So this counts as error. That's a company published the policy of fair value and putting the figure at proportional. Although either method is permitted on acquisition by acquisition basis, the accounting policy of Banana Group is to measure NCI at fair value, and the fair value NCI at acquisition, that is too simple. 20 million shares, their shares are 20 million. It's mentioned on the question. That's a 20 million, par value 1. Multiply by 20% into 4.25. Candidates, if NCI, do remember, if NCI value is not given, then how we calculate the fair value of NCI at acquisition? Just this is the important concept, yes? Just take out the number of shares of the subsidiary and calculate with the market value of shares. And if the market value is not given, an examiner mentioned that, an examiner mentioning that fair value, NCI at fair value, then examiner will given some clue to calculate the fair value. Like in a specimen 1 of the question, you have to attempt that question, specimen 1, where they mention that fair value of NCI at fair value, but fair value of the shares is not given, but there is some indicator about the PE ratio. Then you have to calculate the fair value by the PE ratio and then 20% accordingly. That is the point. So this is the point. Next point is the land fair value. Fair value adjustment land. Net asset at acquisition were incorrectly included at their carrying amount of the 70 million. This should be treated as a 75 million, corresponding 5 million increase to the land in consolidated statement of financial position. Candidates, it's very simple. The fair value adjustment required, and that is 5 million higher than its carrying amount. So 70 plus 5, that's the mention, 75. That is land debit. If it's wrong, land debit, goodwill credit, NCI credit. Now, next point is to calculate the goodwill. Fair value of share exchange, 68, that's absolutely correct. 6.8 multiply by 10 billion shares. Contingent consideration, that's we have already done as above. NCI as above. Fair value consideration as above. Goodwill calculate, it's very simple. And that's particular mention that in the question. Examiner mentioned that show the accounting entry to amend the finance director error. It's particular mention. So if examiner particular mention to show the accounting entry, that's the matter. Goodwill debit, land debit, NCI credit, liability credit. That is the correction of error. Huh? Means land should be increased by 5 million. NCI at 3 million because they have mentioned NCI. They have mentioned NCI at 14. Then 14 minus 17. 14 minus 17. Land upward 5 million. Fair value adjustment. Liability, that is contingent liability, 4 million. So liability credited, NCI credited, land debited, remaining pensions, that's goodwill. Goodwill adjusted by this 2 million. Previously goodwill calculated 12, that's 14 minus 12. So candidate, that is what the matter of fact that's done about it. And final value, I hope that it's clear till now, and it's very simple. Now the next one is acquisition and subsequent disposal of strawberry, and this is point associate. So number one, the point is associate. Number three, why equity accounting appropriate? It's appropriate because Banana had a right to appoint one of the 5 directors, and here is the case. So first point, significant influence, knowledge. If entity holds 20% or more of the voting power investee, it is presumed that the entity has a significant influence, unless it can be clearly demonstrated that this is not the case. The existence of significant influence by an entity is usually evidenced by representation on the board of directors and participation in key making process. Participation. Do remember that. First, identify that it's associated based on significant influence. Then accounting, equity accounting. Banana 40% equity of a strawberry can appoint one director to the board. It would appear that banana has a significant influence but not control. Strawberry should be classified associate and be equity accounted with a consolidated financial statement. Now what is equity accounting? The equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in investor shares of the investing net assets. Candidates, whatever I told you here, whatever the mention in the notes, it's all elaborations. Investor P&L. Now this one is the case. Knowledge, this part is knowledge, this part knowledge, this part case. Investor profit includes share of the profit and loss investor. Sorry. Yes. This part is knowledge, how equity accounting works, and this part is a case. And you can simply identify the case. 1st October X7, Strawberry have included a consolidated financial statement value of 20.4. That is 18 million. That is the cost of investment. Banana, the price paid, that is price paid 18 million. 18 million. Rest when you acquired, sorry, when you acquired, at that point the net asset 44 million, and here the 50 million. So 50 minus 44 into 40%. So 80 minus this, that is 20.4. So it's simple, the equity accounting. Now the important point is this. Disposal of associate. And this is the important point. Disposal of 75% of shares. Banana no longer exercise significant influence over the Strawberry, and a profit of 3 million should be calculated as follows. This is what the important point. And what we have done, the proceed, there are two aspects here. Number 3. Number 1, calculate the gain or loss, and number 2, subsequently what will happen. Do remember one thing. They have disposed 1st October X6, but our year end 30th June X7. That's during the year. And what they have done, Banana recorded a loss in reserve 14 million, calculated the difference between the price paid 18 and the fair value 4 million at the reporting date. That is the wrong treatment. The right treatment is this. Proceed, that is the cost of investment. Sorry, the fair value of consideration received. Fair value of consideration received. Fair value of retained investment. Retained investment, that's calculated above. Candidates, are you with me? Don't lost somewhere. This is a very important point. First time examined in September 18. Banana disposed of 75%, 40% investment, 19 million. This is That is the 19 million. This one. Number one, fair value of remaining investment. Banana stated that that's a remaining investment. The fair value of the remaining investment was 4.5 million at disposal. That is 4.5 million at disposal. And carrying amount of investment, that is 20.4. This one we have calculated here. Equity accounting. So think like that. After disposal, we have get 19 million. We have remaining 4.5. So our position 19 plus 4.5, 23.5 minus whatever we have lost by equity accounting is 20.4. That means 3.1 is the gain. So this is what they have done wrong. But two important point here. They have done incorrect. Banana is incorrect to have recorded a loss reserve 14 million. And this should be reversed. Instead, gain 3.1 should have been included with the consolidated statement of P&L. That's all. Number one. Number two, simple investment accounting after associate to SI, simple investment. And here the company has two options. Company has two options, either fair value through P&L or OCI. So here mention last line, add fair value through OCI. So important point is that when sold the fair value of remaining investment 4.5, the investment is initially restated fair value 4.5 million. Banana does not intend to sell their investment providing that they make an irrevocable election. They can treat the remaining investment at fair value through OCI and the investment will be restated to 4 million at reporting date with the corresponding loss 0.5 OCI. Because here mentioned that the fair value of the remaining investment 4.5 million disposal, but only 4 million at 30th June X7. That is the loss. So candidates, this also done with respect to the September 18, and I strongly suggest you to attempt one more question before the next session. And your assignment is specimen question 1, specimen 1, question 1 of specimen 1. I will not discuss the question in the crash course, but you are now become able to attempt that question. That is very much important to simulate this question in the simulate this question. Candidates, do let me know, is there any issue with respect to this question September 18, that is banana? Then I will respond you accordingly. Do you have an issue? Do let me know on the WhatsApp. Can you please reply me on the WhatsApp group? Yes, candidates, all of the files you will be able to get all of the files. Don't worry about it. uh, I will share you the file in a couple of hours, inshallah ta'ala. um, our next session on tomorrow, um, on Friday, that is 3 p.m. to 6:30 p.m. 3 p.m. to 6:30 p.m. Tomorrow timings is 3 p.m. to 6:30 p.m. Pakistan Standard Times. And you must have to practice these aspects with your own. And I strongly recommend, before next session, before tomorrow's session, you have to attempt the question of specimen 1. Specimen 1, question 1, specimen 1. You have to attempt. So you just download the question from there, and that's all. Thank you very much.